What is a balance sheet? A balance sheet is one of the three fundamental financial statements used to evaluate a business, alongside the income statement and cash flow statement. It provides a snapshot of a company's financial position at a specific point in time, such as December 31st. A balance sheet shows what the company owns, called assets, and what it owes, called liabilities. The difference between these is the shareholder's equity. These components follow the fundamental accounting equation. Assets equals liabilities plus shareholders' equity. This equation must always balance, hence the name balance sheet. Unlike income statements that show performance over a period, balance sheets represent the financial status on a specific date. Companies typically prepare balance sheets quarterly and annually, providing snapshots of their financial position at those points in time. Balance sheets allow investors, creditors, and management to assess the company's financial health, liquidity position, and capital structure. In summary, a balance sheet is a financial snapshot that follows the fundamental equation: assets equals liabilities plus shareholders' equity. A balance sheet contains three main sections: assets, liabilities, and shareholders' equity. Assets are resources owned by a company that have economic value. These are divided into two categories based on their liquidity. Current assets are expected to be converted to cash within 1 year. These include cash, accounts receivable, inventory, and prepaid expenses. Non-current assets have longer-term value, typically beyond 1 year. These include property, plant and equipment, intangible assets, long-term investments, and goodwill. Liabilities are obligations that a company owes to external parties. Like assets, they are also categorized by their time horizon. Current liabilities are due within 1 year. These include accounts payable, short-term debt, current portions of long-term debt, and accrued expenses. Non-current liabilities extend beyond 1 year. These include long-term debt, pension obligations, deferred tax liabilities, and lease obligations. Shareholders' equity represents the net worth of the company, the residual interest in assets after deducting liabilities. Contributed capital represents money invested by shareholders, including common stock, preferred stock, and additional paid-in capital. Retained earnings are accumulated profits that haven't been distributed as dividends, representing reinvestment back into the company. Other equity items include treasury stock, accumulated other comprehensive income, and non-controlling interests in consolidated subsidiaries. Together, these three components form the foundation of the balance sheet, connected by the fundamental accounting equation: assets equal liabilities plus shareholders' equity.